A perfect double top pattern will fail 70% of the time if you ignore the price action to the left of it. Most traders obsess over the signal bar, the hammer, the doji, or the engulfing pattern right at the hard right edge of the chart. But the signal bar is only the final 10% of the trading decision. The other 90% comes from context, which is the sum of every bar that came before it. Context answers the most critical question in trading. Is the market currently trending, or is it in a trading range? This single determination dictates your entire strategy, turning a winning setup in one environment into a guaranteed loss in another. Al Brooks teaches that context is simply the arrangement of recent price action relative to past price action. We must evaluate buying and selling pressure to determine the probability of the next move being a continuation or a reversal. Let's look at a clear example of a strong bull trend. Notice the series of higher highs and higher lows, with very few overlapping bars. In this context, the probability is always skewed to the upside. In a strong bull trend like the one we just saw, bearish reversal patterns usually fail and become bull flags. If you see a perfect double top, context tells you to ignore it or even buy the breakout above it. Conversely, here is a trading range context. The market is oscillating between a support level and a resistance level. The bars are overlapping, tails are prominent on both sides, and there is no clear direction. In a trading range, the strategy flips completely. We buy low, sell high, and scalp for smaller profits. Buying a breakout in a trading range is a low probability bet, as 80% of breakouts from trading ranges fail. To read context, we must analyze the pressure visible in the candles. Bullish pressure is indicated by consecutive bull bars, bars closing near their highs, and gaps remaining open. This tells us the bulls are trapping the bears. Bearish pressure, or selling pressure, shows up as big bear trend bars, tails on the tops of bars, and bull bars that immediately get reversed. When you see this, the context shifts to always in short. Let's apply this to a specific chart scenario. Here, we see a strong move up, followed by a pause. Many traders might see this pause as a reversal, but look at the context. The momentum is clearly up. Because the context is a strong uptrend, those small sideways bars are not a reversal, they are a bull flag. The context dictates that the probability of a breakout to the upside is roughly 60 to 70%. Now, let's look at the magnets. Context also involves identifying where price is likely to go. These are support and resistance levels, measured move targets, or previous highs and lows. A common context tool is the measured move. If the market had a strong leg up and then paused, we project the height of that first leg upward. This target acts as a magnet for price action. Trading against the context is the primary reason beginners lose money. They see a perfect bearish engulfing bar and sell, not realizing they are selling into a strong bull trend and a support level. This leads us to the concept of the second entry. In a strong trend, the first reversal attempt often fails. The context tells us to wait for that failure and enter on the resumption of the trend. Let's analyze a chart where context changes from trend to trading range. Notice how the trend channel lines are broken and the pullbacks start becoming deeper, overlapping the previous breakout points. When the context shifts like this, you must shift your mindset. You stop buying high. You stop expecting measured moves. You start taking profits at the previous high rather than holding for a breakout. Another vital aspect of context is tightness. Are the bars flowing in a tight channel, or is the channel broad? A tight channel is essentially a breakout on a higher time frame and is very hard to reverse. Look at this tight bear channel. Every bar makes a lower high. There are no gaps between bars. Buying here, even on a strong signal bar, is suicide because the context is essentially a plummeting elevator. However, if the channel is broad, with big swings up and down, the context allows for two-sided trading. You can buy the lows and sell the highs of the channel, provided you have a decent signal bar. We must also consider the higher time frame context. A 5-minute reversal pattern might just be a pullback on the 60-minute chart. The higher time frame always holds more weight and provides the big picture direction. Here is a practical exercise, buying a breakout. In a strong trend context, Buying a breakout above a swing high is a high-probability trade. We expect momentum to carry through. Compare that to buying a breakout in a trading range context. Here, the breakout above the high is likely a bull trap. Smart money sells this breakout, fading the move back into the range. This difference is why you cannot automate price action easily. The pattern, a breakout, is identical geometrically, but the context, trend versus range, completely inverts the probability of success. Let's discuss bar counting briefly as a context tool. Al Brooks uses H1, H2, L1, L2 labels. These aren't magic. They simply track the number of attempts the market has made to resume the trend. In a bull trend, the first pullback, H1, often leads to a complex correction, but a second attempt to resume the trend, H2, usually has a higher probability because the bears have tried twice to reverse and failed. Context also tells you when to stay out. If the market is in a tight trading range, 3 or more bars with almost complete overlap, this is barbed wire. The probability is 50/50ths, and the best trade is no trade. Volume is rarely used in pure price action, but volume context can be seen in the size of the bodies. Large bodies equate to high volume and conviction. Small dojis equate to low conviction and indecision. Always look to the left. Are we near a major moving average? The 20-period EMA is a standard institutional reference point. In a trend, the first touch of the EMA is often a major support or resistance point. If price action is far away from the moving average, we say the context is overextended. This increases the probability of a mean reversion trade, or at least warns us not to enter in the direction of the trend. Recap the checklist. 1. Trend or range. 2. Is the channel tight or broad? 3. Where are the magnets, support/resistance? 4. What is the buying/selling pressure of the last few bars? Remember, the signal bar is your entry ticket, but the context is the event. You wouldn't buy a ticket to a concert that ended an hour ago. Don't take a trade signal if the context, the trend, has already ended. When you are confused, the context is likely a trading range. In confusion, the probability is usually neutral. When you see clearly, and the institutional pressure is obvious, that is when probabilities tilt in your favor. For the next week, try to trade without looking at the signal bar first. Cover the right edge. Analyze the structure to the left. Predict where price should go based on structure, then see if the signal bar agrees. Context allows you to anticipate the trade before it happens. It transforms you from a reactive trader, chasing candles, to a proactive trader, waiting for price to step into your trap. Mastering the big picture takes time, but it is the only way to achieve consistency. In our next video, we will deep dive into specific trend lines and channel analysis to refine your context reading further. Context comes first, the signal comes second. Trade well.